just so that you do know, this is venture debt. So exploring new models, equity versus debt. So how do we really unpack this and how do we look at this? So before we start, I would like to have our panelists just give a quick introduction. Where are you from? Who are you? Where are you based? And what's your contribution to the ecosystem? Thank you.
Thanks, Nathaniel. Before I get started, I just wanted to quick poll with the audience. How many startups do we have with us today? And great. And any VCs or capital allocators? Okay, great. So it's good to know. Mostly startups. Great to know that, so we can tailor the conversation to best help you in your journey. So I'm Rana Abdelatif. I'm Egyptian. I live in Cairo, and I work at a fund called Include. We're a fintech-focused fund that invests primarily in Egyptian companies, but we do have quite a bit of a mandate to invest outside of Egypt. And the birth of Include came a few years ago with, accelerated by COVID and the need for further cashless transactions to take place and financial inclusion of sort of the individuals and businesses that were not part of the financial system. And so that was when Include was sort of put together, and we've started deploying last year, and always excited to see new products in the fintech and fintech-enabled spaces to invest in.
Thank you. By the way, the startups were really, impressive. So, great job. I actually really enjoyed the presentations. My name is Bolaji Adeoye. I work at Consonance. I'm Nigerian. Consonance is a sector-agnostic fund. We focus on, pre-seed to Series A. Recently though, we're actually fundraising now. So, so we've been sort of at the other side. So we've been kind of talking all day. But recently, we are launching an accelerator for nature-inspired innovation. We call it biomimicry. Which is going to be embedded into our fund. So we're looking for like 10 candidates that we can sort of graduate in the first cohort, so that we can make some investments once they graduate. So glad to be here, and looking forward to a great conversation.
Hi everyone, my name is Jean-Noël Ollier. Very pleased to be here. Thank you very much for staying so long. We are the last slot in the conference, so trying to keep you entertained and interested. So my name again, Jean-Noël Ollier. I'm a Swiss-French national. I've been in venture capital, private equity, and entrepreneurship for the past 20 years. Started with the venture capital division of Charles Schwab. It was based in the United States back then. I've worked for various other venture capital firms, private equity firms. The last stint was as a partner with Bamboo Capital Partners, which is an impact investment firm based in Geneva, where I was focused on Africa venture capital investment, early stage. So I've been standing on both sides, on the financing side, but also on the entrepreneurship side, having started myself a couple of companies as a co-founder position.
Phenomenal. Thank you so much. Can we give our panelists a round of applause? Great. I love that everyone's still alive.
We should have asked them after we finished.
No, it's
just to make sure we earned it.
It's multiple. It's multiple. I'm sure you will. So, Jean-Noël Ollier, maybe to start with you, if we're taking a look at the economics of financing your venture, we know that there's a lot of equity investors that are lacking some dry powder in the ecosystem, especially with the market downturn, and also with winter times that are abruptly coming, and we don't know when it's going to end. I would like to know, if we're chatting to an audience of startups, I'm very curious to find out, when you're navigating around raising equity and debt within this time period, what recommendations could you give forward to some of the founders in the audience in terms of navigating the pool of, should I raise equity now or should I raise debt, and when is a good time to do that?
Yeah, absolutely. I'm happy to do that. So typically, the equity is the underwriting of the ultimate risk of the company, right? So usually equity is the first type of financing that you're getting. And then when the company matures and is able to produce what lenders like, which is collateral. So if you start having inventory, if you start having receivables, if you start having long-term assets that you can finance against, then debt becomes your friend. Okay, it doesn't mean that you can't do debt, and that's the whole purpose of the discussion today, is that we are seeing, first of all, the two of the equity and the debt converging. So you have a handful of hybrid instruments which combine the benefit and the risk of debt and equity. And also you're seeing a migration more and more, and that's probably more recent, where you're seeing debt being done more at an earlier stage through various type of mechanism. One of the reasons, and it's not so much, and that's my personal interpretation, is that the migration of debt towards an early stage is not so much reflective of the fact that debt wants to take more risk, is more reflecting of the fact that there is an abundance of debt capital that's looking to be deployed. And that is just, so it's an opportunity for a founder if there is to take on debt instead of equity, because you avoid the dilution. And at the end of the day, the risk to you is not that much different. At the end of the day, if the company goes bust and you won't repay the debt and you won't repay the equity, so the risk, there is less dilution and less risk on your side.
Can I add to that? I just wanted to add a couple of things, because we typically do earlier stage investments, and we work with our founders early on to prepare them for the need of debt. But a few words to the why. So, debt is there to support your business. It's not there to replace equity. Debt is going to put a significant burden sooner or later on your cash flows. So before you go out and start raising for debt, you need to be absolutely sure that your cash flows can sustain. Debt can be a form of dilution, so it's really important once you're ready and out there and negotiating, it's really, really important for you to understand what the terms of this debt facility really mean, and sort of using your equity investors and your service providers and supporters, and going back to them to understand really the extent of which this debt facility will have an impact on your business. And last but not least, the earlier the better. If you prepare yourselves as a business in terms of reporting, in terms of being clean around your reporting and data, in terms of having good governance, you'll have a much easier time to be able to raise that facility when the time comes.
100%. Thank you so much, Rona. Maybe to bounce the ball to you, Mobolaji, I'm quite interested to find out, when you look at newborn companies, right, a lot of them are coming out raising debt. You're also looking at other sectors where you look at like deep tech or other like industries where the capital is a little bit higher than what you would do if you're looking at a simple SaaS or another like fintech model startup. So I'm quite interested to find out like what's your opinion on raising debt, and at what stage do you think is the right method in order to go forward with it?
Yeah, I mean, I do agree that, with my co-panelists, that you have to be very cautious about raising debt, right, until you have some level of stability in your revenue or sizable revenue. You need some predictability. Otherwise, you're going to introduce some level of fragility into your business, right? Because at the early stage, you're experimenting, and you need that flexibility to be able to sort of make those decisions. So we often say that, resilience is a feature, not a bug. It's something that most people don't, it's tough to hear that. But I think once you think that you need debt broadly, I think the real question is, how to sort of pare down your operating expenses, right? And I think negotiating with your suppliers, as well. But in terms of the different kind of models that we've seen, we run a debt program for our portfolio companies. And we've kind of seen some of the ones that did well and some of the ones that struggled. I think SaaS models are very attractive candidates for debt, mainly because they tend to have very high margins, right? They tend to have predictable flow of revenue. And I think that at the end of the day, we are underwriting their customers, especially when we can identify those customers, right? So the critical thing for us is that we want to be as close to that collection as much as possible. The other types of businesses that that I think can also take on some debt are businesses that are orchestrating value chains, right, or integrating value chains, where that debt opportunity, is being demanded by maybe SMEs that they are supporting. They've built some level of clarity around the flow of transactions. So once we see that, we can somewhat predict, what the flow of revenue will be, so we can sort of underwrite that. So I mean, there are opportunities to do that, right? I mean, but it's on a case-by-case basis.
100%. And I mean, you did mention that you're fundraising at the moment.
Yeah, I am.
During the hottest winter we've ever experienced. So, considering that winter, and I mean, I've seen a lot of fund managers are like struggling to close their second, their third rounds because, everyone is kind of like cash tight. Yeah. So based on your experience from fundraising this year, and you don't have to answer this question because I know it goes a little bit personal, but I'd like to know, for instance, like, has there been any consideration on developing more on the debt side because of the landscape, of the economic landscape we're into? Or what's the plan going forward in case, things go to the latter or go to the right? Or what's the contingency plan for risk?
In terms of, are we seeing people raising debt or equity? I just want to be clear.
So people raising equity,
Yeah.
but might not be successful in raising that full, equity round,
Yeah.
and might have to consider, other options like debt.
Yeah. So I mean, I think when you're sort of at the, almost sort of like at a growth phase, right? And you want to sort of extend your, maybe like you want to grow faster, right? You can sort of supplement your equity with debt, especially if you don't want additional dilution, But the principles still apply, what I mentioned earlier about, there has to be stability of there has to be some level of consistency in revenue and stability of revenue. The reality is that most creditors still want to underwrite based on a collateral. Where the creativity occurs is, how you define the collateral, right? And I think there's a lot of flexibility around that based on your business model. I'll give you an example. There was a company that we helped provide debt capital to. They're a payment company, similar to Yoko. I don't know if you know Yoko. So they have point of sales devices. So the point of sales devices became collateral. And we're comfortable with that because, those can be transferred to somebody else, right? So those are some of the types of, but I think, the same principles apply. I think, but if you're a growth company, I think you just have a bit more, your flexibility and the scope of sort of repayments is higher. Yeah.
So I would add perhaps that, you're rightfully pointing out that, the decision on, when is the right time for debt is really looking at the fundamentals of the company, the P&L and the balance sheet, the type of collateral a company is able to produce. The other point of view that you can take is the point of view of the insider, right? So you have several people. You have the founder, you have the early stage investors who have equity capital, and then you have a potential debt provider. Right? And we had a situation, very interesting situation, with an investment we were making back in the Bamboos days. It was a South African company. And we led the pre-Series A. That was a pure equity investment. We were, we bridged the company to get to a steady growth path, which the company achieved. We managed to have a Series A led by a very good deep-pocketed investor at a valuation that was a little bit below what we were hoping. And when I say we, is the founder and us as early-stage investor. But we still accepted that because this was quality money, a lot of dry powder. they wanted to acquire more and more equity, and they wanted to keep funding the company. They wanted to deploy the capital over and beyond what they had put in the Series A. We found a win-win situation by agreeing that they would fund the company through a shareholder loan as opposed to another round of equity after the Series A, right? Why this was interesting for them is that they could have a more secure investment, so they get first in line in the capital structure of the company. So if something goes wrong, then they get that chunk of money back. And for us, that was an opportunity to avoid further dilution. So we get penalized in a way in the first round because we got diluted more than we were hoping, but that wasn't going to happen again because that debt was structured as a convertible debt. So yes, they were getting a bit of an interest paid in cash, but that there was prime plus 3%, which is by South African standards super low. Their return was achieved by an agreement that they would convert with a minimum return of, I don't know, I think it was 20 or 25%. That's a lot more juicier for them, okay? Almost like equity return. But we knew that between the agreement, the deployment of this loan and the conversion, we would do a lot more than 25% increase of the equity value. We would do like 3 times, 4 times that. So we were very happy to give 25% to the note holder in exchange of their conversion rights. And they were very happy because 25% on that is pretty cool as well. Right? So it was a win-win situation between.
Phenomenal. So maybe I want to do a little change up here because we have a room full of incredible founders. I just want to see by a show of hands, how many of you guys have actually raised debt during the course of your company growth? So there's 1, there's 2.
How many have thought about it? Okay.
Okay.
What stopped you?
No, really. What stopped you? Maybe if we can get another chair up here, we can maybe do a little bit of a fishbowl.
Yeah.
I think that would be really nice.
Great
Also get a mic.
Great to understand his experience.
Yeah, I'd love to get that experience. So where is one of those people who have raised debt? Maybe Mr. Hein from Arabo Growth. What was your experience like?
Hi, everyone. Yeah, so Hein from Arable Grow. We were fortunate enough to find investors that were willing to help us in an industry that's very young and very new. And we realized we had to raise a little bit of debt. So we kind of raised interest-free debt, but had to offer up a little piece of equity. So there's always a little give and take. And what we're doing at the moment, we're a very asset-heavy company. So we've opened a pre-seed round and considering a portion of that to go still debt financing. But we have ran the numbers to know that the revenue can kind of sustain it. But maybe a question would be, who to target, because especially in our industry, when it's new technology, it's a new industry in the local market. So going to someone and asking for debt, then immediately that interest risk goes up because they don't understand it. So who maybe is the best people to then approach or industry to approach when it comes to a high risk industry?
I didn't pick up the last.
Who are the people to approach?
Yeah.
Who are the people to approach
Yeah, I'm very active in the the West African market. I will say the asset managers, are the guys that can take a certain level of risk. But what we are seeing now is that some of the banks as well are beginning to set up venture debt desk. We just made an introduction to a financial management software. We made an introduction to a bank. So I think the last few years, even though it's winter time, but I think the benefits of sort of like the, I want to say like a hype cycle for VC has kind of attracted, a lot of asset managers and even banks, looking to provide debt. You know, I mean, the banks, they tend to be a bit more. The process tends to take a bit longer, but they tend to provide better rates.
And you mentioned it's an asset-heavy business. I mean, we've seen in Egypt at least, and we're a very conservative banking system, a very traditional banking system, but we've seen that there is more and more appetite, and in fact, they've started deploying. Can I say things? HSBC, for the most part, has been spearheading this quasi-venture debt because it's not really venture debt. They're financing working capital for these asset-heavy businesses, but yet they're still not able to digest the idea of lending to the lenders. But when it comes to businesses that are sort of, like you said, enabling certain verticals or the value chain, they're starting to have more and more of an appetite. So I would say, first of all, speak to your equity investors and really push hard on getting them to support you and identifying who the key people to speak to are. But we're seeing more and more commercial banks starting to have that appetite and getting a little bit of that FOMO in venture deals.
Cool. I think we should continue with some Q&A. Are there any questions out there?
More questions do we have on the floor? I know we had mentioned somebody who had started building at this or got the debt, right? And then we were asking those who were thinking, why not getting into it? So perhaps we could ask some of those.
100%. Or even the ones who put their hands up considering venture debt.
There
I'd
we
also
go.
like to know why you didn't go ahead with it. Like, that's quite
Anybody
interesting.
got a question on that? Or share your thoughts on why I didn't go that route?
I know it's almost 4 o'clock, and I know our cogwheels aren't really turning as fast as they
We
used
should be
to.
sitting outside now having a drink.
No, I agree. I agree. Drown ourselves in a different kind of debt that our bodies will feel the next day. But awesome. So I'm assuming that there's no questions. I mean, these are 3 very incredible minds who could really help you figure out, that little turmoil which you might not have again. So, going once, going twice. There's no pressure.
I think we should also touch base on, and maybe since you guys have
Yeah.
done debt, venture debt specifically, I think we should touch base on local currency debt versus USD debt. And given, we're all coming from emerging markets with very volatile, fluctuating exchange rates and having sort of that exposure to your business and the hedging costs. So I think maybe let's share some experiences of local currency debt versus USD and where maybe the availability of USD can be more appealing, but what that exactly means for the business later on.
Sure. Do you want to take this? I'm happy to answer.
Yeah, I think in general, I always advise our founders to match, their debt, the currency of their debt with their revenue, right? So if you're earning Naira, don't take on USD debt, right? We've seen a lot of, very unfortunate scenarios, where, folks, the devaluation happened. And again, I'm talking about Nigeria, where devaluation happened and, they just couldn't keep up. But I'll definitely advise, founders to find someone that is an expert to advise them, because sometimes, this dynamic doesn't necessarily apply, particularly if you are looking for very short tenor debt, right? Wherever you are sort of like on the sort of, depending on how sort of like the yield curve is, sometimes hard currency debt may be cheaper actually, right? And I think in Nigeria, this is probably one of those periods where hard currency debt may be slightly cheaper because, you are looking at sort of getting a debt at maybe about 12, venture debt about maybe 12%, but local currency is probably going to be about 24%. So if you're doing sort of like a year, if you're sort of looking at a year tenor, there's just so much uncertainty in the movements of the Naira and the USD that you may not want to take that risk, So I think there's sometimes, hard currency may be better, So I don't want to be too general, but I think, the rule is to sort of match your revenue, match the currency of your revenue with the currency of your debt. Yeah.
I think the only thing that can be said about which one is cheaper between local currency is that you don't know, right? Or you only know when you've repaid back your foreign currency loan. Because at the end of the day, the missing variable is the exchange rate at the time of repayment, right? So if it's a bullet repayment, it's huge risk. If it's an amortizing debt, then you average out because then the currency will fluctuate. If you're in a country like many countries in Africa where you have structurally weak economies, that should translate into structurally weak currencies, so you know that your currency will depreciate and your foreign currency loan will be more and more expensive. So unless you have a very strong view, if you have the choice, unless you have a very strong view on the movement of currency going forward, in which case you might want to be a currency trader rather than an entrepreneur. You should go for local currency as much as you possibly can. But sometimes you don't have a choice because, in many startups, you have development finance institutions that offer USD denominated loan. And usually for early stage companies, that's their mission to do that. It is not necessarily the mission of the local banks to lend in local currency at attractive rates. So I've seen many startups that are taking foreign currency loans just because they don't have a choice.
Testing 1, 2, better. So I just want to say thank you for all of the contributions. We've covered a very large array of various type of debt models that we could look at. Currency exchanges, obviously, if you're looking at raising from a hard currency, we've also taken a look at other type of models and also other circumstances where you can actually think about raising equity versus debt and in what stage you'd be raising. I would love to thank all the panelists, Rana, Mobilaji, and then also obviously Jean-Laurent Audier. Thank you so much for joining us today and sharing your knowledge with all of us on stage. And now, as you expressed earlier, could we give them a round of applause just to close it off? I think this is the moment. Do you think they deserved it? That's when you should go louder. Yeah, that's the one. Cool. Thank you so much.
Thank you. Debt versus equity, new models to explore during winter times, because winter is coming. Indeed, it is. Nathaniel, I guess you could probably stay on stage this time, couldn't you? Since we're having our awards and everything. All right. Christoph, come and join me on stage, please. It is that time of the afternoon where we get to put you on the spotlight for a couple of minutes. Thank you, guys. Thank you, gentlemen. Do you have a microphone? No. Tell me how you want to use it, by the way. All right, ladies and gentlemen, it's been a fantastic couple of days at the Africa Arena, the African Tech Ecosystem Accelerator Summit. So I'm sure those of you who have been joining Africa Arena even before these 2 days started would have been having some fun from the boot camps that were taking place and so much more that was happening. And over the last 2 days, we've been having some real conversations that many of our startups and investors could take home and have some conversations back where they're from, and I guess start thinking differently about how we can make an impact on the African continent. And then, of course, the game is to go from Africa and beyond. Just yesterday I was teasing, we all say Africa is alive with possibilities, yes, the possibilities are there, but all these things are dreams unless we actually do things about it and we get active about it. And if there's a team that has been trying to do that is Africa Arena. Christoph and Nathaniel are going to come back a little bit later on in the next couple of minutes because we do have some awards that need to be handed out for this afternoon. So thank you to each and every single one of you who have joined us. Stay with us because we do have to hand out some of those awards. Our startups did so well during the pitching sessions, and I'm sure it was nerve-wracking sharing with everybody what it is that they're trying to do. But of course, there can only be winners, and then of course some of those we celebrate their successes as well. So we'll give it a few minutes. Thank you so much, DJ, and we'll be back with our awards ceremony.